Good afternoon, Philip.
Afternoon, George. How are you?
Yeah, I'm very well. Thank you. Yourself? So today's webinar is very much focused on the UK property market and Birmingham more specifically, looking at the rental, well, the capital and the rental market in the city of Birmingham, but across the UK. What has happened with this presentation is it's grown into a larger presentation than the invitation discussion point. So please excuse us for that, but we got a lot of requests from customers to give a more generic update on the UK market as a whole. So there is quite a lot of content. Bear with us. We will try and talk over it as much as we can, and hopefully it will be valuable and useful for everyone attending. So a quick introduction to myself. I'm George Radford. I'm the Managing Director for the RPA Group for the UK and Africa. And I'm delighted to be joined by our expert and our guest speaker today, Philip Rines of BRIC Management and Lettings. Phil is the founder and the CEO of BRIC, and BRIC are RPA's lettings and management partner. So all of our clients use BRIC, and Phil and his team provide a fantastic service to all of our customers. So great to have you on today, Phil, and thank you very much for joining.
Yeah, thank you very much for the invite. Much appreciated. Looking forward to today's webinar.
Yeah, thank you. So in terms of what we're going to discuss, we will kind of keep it fairly on track, but how the market fared last year, the UK property market, the outlook for the coming year, for 2024, for this year, sorry. And then we'll have a look at a number of UK cities, including Manchester and London, because we've had a lot of clients request we cover that, but with a specific focus on Birmingham. And then we will be looking at a number of our Birmingham projects, the pending completions of those projects, and talking to Phil about what to expect as an owner of one of these apartments, and what to expect, as completion comes, and what you need to do, and what Phil will do from a lettings and management perspective. So let us commence. So Phil, I think it'd be fair to say that 2023 was quite an interesting stroke challenging year for the UK property market.
Yeah, I was going to say it was a year, I suppose, where there was a number of sort of variables, but actually I think as the year progressed on and confidence certainly was witnessed to sort of return back into the marketplace.
Yeah, there was a lot of press, wasn't there? Doomsday book, Armageddon. The UK property market's going to fall off a cliff. Ukraine war, quantitative easing finally coming to the surface. Post-Brexit, post-COVID, ramifications kicking in. Inflation spiraling out of control. Bank of England and all central banks around the world raising central bank rates to try and curb inflation very aggressively. And we didn't quite know where it was going to end, did we? In truth,
No.
But the UK market fared very well despite a lot of those headwinds. So last year, annual house price deflation maybe, minus 1.1%. That was across the whole UK as a whole. And really the strength of the market, I think, was underpinned by some key factors. The strength of the labour market and the wage inflation. That was one of the primary drivers, wasn't it, for the Bank of England continuing to raise the base rate, because despite inflation coming under control, because wage inflation was still so healthy, the Bank of England had to keep increasing the base rate to sort of counter that. And we've seen over the last couple of months, last few meetings, they haven't increased base rate, which is very encouraging, and we're expecting that to come down quite heavily over this year and 2024. which will obviously have a direct impact on mortgage lending rates. It's got there a more flexible attitude by lenders towards repayments. So yeah, not so many forced sales. But I think really for me, one of the key ones was the checks and measures put in place by banks on mortgages to ensure people aren't over leveraging and aren't taking loans they can't afford. Really played a crucial role. People weren't taking 100% mortgages when they were buying a lot of these properties. So that helped the market remain relatively stable. I'm bringing you in now, Phil. Obviously, it was a fantastic year for the rental market, in contrast.
Yes, it was. I mean, I suppose for certainly throughout 2023, one of the, I suppose, sort of the key influences, I suppose, was supply and demand, perhaps with a slightly quieter sales market. And sort of people sitting on the fence, just seeing as to how it would unfold. We found ourselves where there was a shortage of rental stock predominantly, and obviously a surge in tenants. And with that, rental increases went forward at a significant pace, achieving sort of double-digit increases right across the board, really.
And that surge, it's multifaceted, isn't it? The surge in tenant demand, because the supply side became more constrained. The rental demand increased because we had stuff like the government Help to Buy scheme coming to an end, where a lot of would-be first-time buyers were no longer able to buy. One, because the Help to Buy scheme came to an end and government-backed mortgages didn't exist. And two, because interest rates were so much higher anyway, that even on an affordability perspective, possibly with Help to Buy, they may not have been able to buy. And a lot of people were skeptical about job security as well. So, and that was like the perfect storm, I suppose, for all of those would-be buyers being forced onto the rental market. And that just flooded it, didn't it? Really?
Yeah, and sort of post-COVID as well. I mean, obviously, again, that was a significant shift in the marketplace for the last few years. So, we've noticed drastically a change in regards to single living. So perhaps before, a two-bedroom might attract perhaps two professional sharers. Perhaps they work together or friends. Now, post-COVID, it's very common for people to work from home or a proportion at home. So they require their own dwelling, so their own one or two bedroom property where they might have a work from home office or such like. So again, we are finding there's a lot more sort of single living as opposed to perhaps more of a sharing status previously.
So in layman terms, I suppose, two-bed apartments, which maybe previously would have catered for two people, quite often now you're seeing maybe one person renting those and using the other one as a home office.
Exactly that. So, previously, before, two bedrooms would have been perhaps a family or two professional or tenants sharing. But now we're finding it single or a couple that are using the second room as a work from home office. And yeah, I was going to say that's something that is significant that we see day in, day out.
Yeah, interesting. And then we've got down here the new build nuance. So essentially what it's saying here, the average UK property price now £285,000 average price, whereas the new build, the average price of a new build is 425,000 approximately. So a premium of 52%, and the new build market saw an increase in value of sort of 20% last year across as a whole. Why do you believe that people pay a premium, and both from a capital perspective and from a rental perspective, for a new build property?
I mean, again, sort of speaking with landlords firsthand, new build properties are proved very attractive, for a few reasons. Firstly, obviously, with a new build, you have the energy efficiency. So with the cost of living, obviously, as a tenant point of view, financially, they know where they are, and they can sort of plan and finance and budget. So of course, energy efficiency is key. But also in regards to, new builds, the lower maintenance. So again, as a landlord, the costs are lower. Often, obviously, with these new builds, they'll have warranty periods in place as well. So again, complete peace of mind for the first year, 2 years, or whatever it may be on the policy. And of course, with the new builds, they echo really what people are looking for currently in the marketplace. Open plan living. The fact that perhaps they've got external balconies or terraces. Again, post-COVID, external spaces, is sought after. But yeah, people like the new properties, probably on a financial basis more than anything else.
Yeah, agreed. And as you said, it caters for modern day living, ICT connections, and all of that.
Yeah.
Okay, mindful of time, but very interesting discussion points there. So, Phil, you're very close to the Birmingham market. You've got an office in Birmingham. It is a city in its own right, the second biggest city in the UK, obviously after London. And despite the UK market as a whole contracting by 1.1% last year, Birmingham, depending on what you're reading, what data you're analysing, anywhere from 1 to 4% increase in capital values in the Birmingham market. Largely driven, I would say, by the strength of the local economy and the lack of supply of really good property stock certainly within central Birmingham. Would you tend to agree with that?
Yeah, I would agree. As I say, a lot of the new stock is 1 and 2 bedrooms, which we just addressed. Is the really where the marketplace is for particularly young professionals. We see on a day-to-day basis a lot of people relocating actually into Birmingham from outside cities, whether that be from London or such like. And again, obviously the drive that is really sort of a costing. They get a bit more for their money. And perhaps where they do work from home 3-4 days a week, now they don't mind commuting down to London for argument's sake, in order to fulfill their sort of, their employment requirements.
Yeah. And there's a very strong job creation there as well, isn't there? So
yeah, a lot of companies relocating into Birmingham. We've seen obviously with the likes of HSBC and PwC and such like. So yeah, we work closely with a lot of those local companies and relocate a number of their employees.
Okay, fantastic. And then just from a land registry perspective, you can see that the new build sector of the Birmingham property market outperformed the broader market. So essentially new builds outperforming, as we mentioned earlier, existing stock. And from an outlook perspective on a capital growth, from a capital growth point of view, 21-22% growth over the next 4 or 5 years. So again, incredibly positive for Birmingham. What we saw, sorry, skip the slide. At least we know it's live. What we saw from, I suppose it's quite interesting the last couple of weeks, isn't it, in particular? Just how the view has changed on the UK market. I mean, I've always been a very positive person when it comes to the UK property market and always believe in it, but there was a lot of scaremongering going on, and I think this is a very good example. Knight Frank, for example, had a fairly negative outlook on the UK, fair but negative outlook on the UK property market, and they were expecting capital values to decrease by 4%, as you can see over here on the right hand side, and for this year back in October, and as of now, their forecast is for it to grow by 3%, so a swing of 7%, which is quite significant. And a lot of other sort of property houses have formed a similar view. I think it's fair to say. Why? Inflation is under control, as we mentioned earlier. For a lot of our clients, international clients, probably getting quite excited seeing 5-year fixed rate mortgage deals dropping below 4%. Unfortunately, that is for UK-based buyers, UK tax residents, and for loan sizes of a certain amount and a certain loan to value. So, but what we're trying to show there is that the local lending market has become so much more competitive. Banks are fighting for business, and lending rates are dropping significantly in the local market. And as base rate comes down over the next few months and years, international lending rates will, of course, continue to come down as well. But it starts locally. And we've seen a very positive start to the year in terms of sales as well, haven't we? Just to, focus in a little bit more, I suppose. So asking prices, 1.3% increase between December and January. So it shows we started to see a spike with that base rate, with the Bank of England base rate stabilizing for a few months prior to that and not increasing. It brought confidence to the market, and that's why we saw that increase, December to Jan of 1.3%, which was the biggest increase since the pandemic. A lot more sales agreed. 20% more sales agreed in Jan 2024 than the previous January. 15% more properties, and a hell of a lot more mortgage products. More mortgage products on the market now than have been for the last 15 years. So just sort of reinforcing that point of it becoming a far more competitive arena for the banks to try and win the business, which is driving down the rates. Phil, bring you in on the right-hand chart. So we've got the UK average capital value increases 18.6% over the next 5 years. Looking pretty positive, really. Northwest 21.5, same as the West Midlands, so Birmingham, Manchester. London not faring quite so well. Not faring quite so well. Still 17.4%.
So it's still quite healthy, yes.
On a bigger property value, still decent in terms of returns. Why do you think it's not so as high as the other markets?
I think, again, just speaking with landlords on a daily basis, obviously for London's always a safe sort of haven, I suppose, for a lot of investors, and obviously no one can really sort of argue with the demand and the market there. But I suppose sort of as you head further north, the Midlands, for argument's sake, you do get a little bit more for your money. Obviously, the cost of the properties is somewhat lesser. And, with the likes of HS2, that's still obviously continuing to, obviously, Birmingham and such like that, again, obviously I suppose the potential for the growth and the relocation of businesses and the general attitude and appetite, I suppose, for a lot of investors is perhaps to look slightly further afield, but within easy striking reach of London. And, I think we've certainly found in the marketplace, again, sort of post-COVID, the exits from London out, and now we're seeing that return back in. So I think, obviously London 17.4% is still healthy, but of course it's probably driven a little bit by pricing point. Yeah,
and a bit of a flight to value, I suppose, from an investor perspective. We know the interest internationally and locally into these regional cities like Birmingham and Manchester, don't we? But I think it is worth noting that the capital values in London are still 17% lower than the last peak in 2015. So there's a massive value proposition presented with London property. We're seeing, prime central London re-emerge really as one of the safe haven markets against any other asset classes globally. And as we know very well, Phil, London is a fantastic market for rentals. On here you can see that we look on the right-hand side, the London rental market is actually set to outperform the UK average quite significantly, 29% growth over the next 5 years. And I know that the properties you manage in London, for example, they always tenant very, very easily, don't they? So that's definitely a benefit.
Yeah, exactly. I mean, obviously for the rental market, in London, the tenant pool is large. And again, obviously with the recent sort of slower perhaps development of new builds coming in and the supply demand sort of shift, comfortable rental increases are forecasted, and we have a significant demand for property, and I can't see that changing or shifting over the next few years.
Yeah, indeed. London's always going to be a safe haven, isn't it?
Indeed.
And naturally, it is the largest city in the country. It's the headquarter of many global companies, and it was more heavily impacted than regional cities during COVID as well, wasn't it? All the talk of the working from home culture being the new norm, never going back to the offices, the death of the city. London is bouncing back with a vengeance for sure. So just mindful of time. So Savills forecast, but pretty much in line with what we're talking about in terms of the escalations across the various regions of the UK from a capital growth perspective. Bill, can I pass over to you just for clients joining today's call, just to add a bit more depth to your business and to more introduce it in a bit more detail, if you wouldn't mind, the services you provide and so on and so forth.
Yeah, of course, George. So yeah, I mean, obviously for brick management and lettings, we are specialists solely in the letting and management of UK property. We're portfolio managers, so we offer a nationwide service to our landlords and clients. We do everything in-house and all under one roof. So again, our sort of USP, I suppose, is if you have a property in Birmingham, a property in London, Manchester, or wherever it may be, again, we deal with all that for you, all within the same team. So it's not multiple companies or persons you're having to deal with. We're set up predominantly for investors, obviously based overseas. We have a 24/7 portal, which is available to landlords and tenants alike. So at any one point, information could be obtained and viewed. And for ourselves, as I say, again, for landlords, we only offer a full managed service. We look after the properties if they were our own. We have a 24/7 emergency maintenance, so full asset protection and peace of mind for our landlords. We manage hundreds of properties right across the UK, from the south coast all the way up as far as Newcastle and anywhere in between. But over the last sort of 12 months or so, the rental market has been seen significant sort of steps forward, and just some of the stats there, just to give you an idea on listings as such. From listing a property for rental to actually securing a tenant, is within 2 weeks as an average. Very often than not, properties will let a lot quicker than that. And the ones that are slightly longer, it's perhaps because there's a tenant in situ or access or whatever it may be issues. And with that shortage of supply and demand, we're finding that 2/3 of our tenancies actually extend on for a second or a third year term. So again, which sort of further, I suppose, sort of emphasises the problem of supply, where tenants are staying put, that we're finding shortage of stock. As a landlord, most of our landlords, our average is, they just own under 2 units per property, so per landlord. So most of our landlords will be multiple landlords.
Excellent. And I know you've always done a sterling job by all of my clients. So
thank you.
We're grateful for that. And a lot of good reviews there obviously. Yeah,
I was going to say, we obviously sort of pride ourselves on our reputation, and obviously for all referrals that we receive.
Yeah, and worth adding, I suppose, a lot of other clients who we've gained along as the years have gone by have also come over to you, haven't they, from other providers, because of the quality of the service you provide. I think the big selling point for our clients with regard to your services, Phil, is you understand, you've worked in the industry for decades, you understand the international client as well.
Yeah, that was, I mean, the reason why brick management and letting has really come into fruition and come into the marketplace is the fact that over the 20 or so years experience in the property market, Many a time I saw international landlords and landlords not having their portfolios properly looked after or adhered to, and there was an opportunity to make good that problem. And yeah, obviously Brick Management and Lettings have come in there and using all that knowledge really, and ensuring that we offer a seamless service to our landlords.
Yeah, because it is, I deal with international clients every day, obviously, and it can be quite confusing, and to fully understand, what do you need to do, what do you need to be aware of, what's the process, how do I manage it from afar, how can I trust this person, and so on and so forth. And it's really important to have someone on the ground who understands the international client mindset,
Yeah, I mean,
and the questions that they have. And you've got a UK footprint, you've got a fantastic team, and always available, which makes a big difference.
Yeah.
We can just have a quick look back from your side. So the average rental increase last year for the UK, 9%. From a Brick perspective, what was it across your portfolio?
Yeah, so I mean, sort of specifics to Brick, for landlords that obviously have found themselves where tenants have given notice and we've re-advertised and brought the property back to the marketplace. As an average, we've actually achieved a rental increase of 14.98% on rent increase from a relet property.
15%, so almost 50% outperforming the market there, Phil. Well done.
Yeah, definitely. And if landlord for tenants that have stayed on for a second or a third year term, again, double digit returns is double digit renewals is what we've achieved as an average. So yeah, we actively sort of try and push those rents forwards for our landlords understanding their needs.
Just in the interest of, I'm going to skip to the next slide, Phil, because I want to just talk over Manchester, Birmingham, London. Compare, and then we'll go into Birmingham and look at the developments there, and I've got a number of questions that clients have asked me that I'd like to put to you as well.
Awesome.
So I know that you're very busy in London, Birmingham, Manchester, all fantastic cities in their own right. What have you seen happening in Manchester? I know it's a very strong economy, isn't it? And we're very active there. It's got an amazing football team, Man United, not so amazing at the moment. Had to slip that one in there. But how are you finding the Manchester market currently, Phil, from a rental perspective?
Again, obviously, Manchester sort of echoes many of the other cities. Shortage of stock predominantly is the driver for the rental increases that we are witnessing. Big demand from tenants. Young professionals relocating again a lot into the city centre itself. The demand is more so for the more modern apartments. They boast good locations and gain good access into the cities. For again, Manchester itself is probably one of our hottest markets. So when the properties come on, we know full well that the phone's going to ring off the hook with applicants looking to take up tenancies.
Yeah, that's very much sort of echoes what we've experienced as well. I think we've covered quite a lot, haven't we, on the London market in our discussion.
I think it's really more so just to sort of go, the 5-year forecast for rentals is they're really only going one way.
Yeah.
And obviously they're big numbers, 21.5%, but that to me it doesn't faze me. I think it probably may well be slightly greater than that, judging by the appetite we see on a day-to-day basis.
Well, I think also it's a very good point, because if you look at this, is largely driven by the supply side, and the UK property market, I think it's fair to say that is the primary driver. The strength of the economy aside, it's a supply and demand imbalance, simple law of economics. And what we've seen, certainly over the last 12, 18 months, with inflation, with interest rates rising, that has not only impacted landlords, it's massively impacted developers. So a lot of developers aren't building. If you look at the number of planning applications, the number of planning approvals in the system over the last 12 months significantly down. So the supply side we're seeing now, in terms of the constrained supply we're currently experiencing, in my view, over the next 12 months, 18 months, that's probably continue to get worse because it hasn't come through the system yet. Do you understand what I'm saying? Over the last 12, 18 months, when the brakes have been put on quite heavily in the construction market, for all of those reasons that we've mentioned, we're still not seeing that coming through in terms of physical completed product. You know, and the engine needs to restart again, doesn't it? From a lot of developers' perspective, a lot of planning applications we know they take ages. So,
and of course, you've got the time. You've got the time frame to build it as well. So
exactly. So there's a massive lag in all of this information coming through. So personally, I feel for the next 4 or 5 years, in particular, from a supply side, the UK market is going to be heavily constrained, which is good for landlords, good for investors. Okay, so what we actually set the webinar up for, Phil, was to talk about Birmingham. So let's delve into that in a bit more detail. We've been very busy in Birmingham. You're always very busy in Birmingham. I know that you're very familiar with all of our developments, specifically here within the jewellery quarter. The sort of master plan we've been working on for many years with King's Crescent Homes, our development partner. We've got a lot of customers who've joined the call today just to understand a bit more about what's going on. So Tyndall Court under construction. That was the 4th phase. Sloane Court, that's the new launch, which I know you're familiar with, Phil, opposite Tyndall Court on Sloane Street. That's the 5th phase. The first phase, going back in time, was the Copperworks, which I know you and your team were very much involved with, and 72 new build apartments in there. Second phase was New Schoolhouse. The 3rd phase was Scholar Quarter, which we'll come on to. So there's been 5 phases around this area of the jewellery quarter that the RPA group have been working very closely with King's Crescent Homes, the developer, and also Brick Management and Lettings. So I'd really like to sort of delve in a bit more, Phil, into you know, how you found it with the Copperworks. You know, that's a proven product, completed, and you manage a lot of those tenancies. How did that go? And you know, maybe we can use that as a case study from a process perspective to tell clients, you know, what they should be expecting over the coming weeks, as you know, the likes of Scholars Quarter. Show some of these images first, and then I'll come back to that question if you don't mind. So Scholars Quarter is the next phase to complete. 100 apartments, 1 and 2 bed units, just off Leg Lane. You were there last week, I believe, Phil.
Yes,
so the show apartment's up and running, it's ready. The view looks fantastic. And the exterior, these are from December, so still a little bit of landscaping and whatnot to be done. But we are now in a position where we'll be looking at completions early mid-Feb for some phases of Scholars Quarters, block F and G. So maybe what we could do, just going back to my question, is to just look at, from a customer perspective, here we are now 4 weeks away from some of these units completing. What happens next from a client perspective and from a Brick Lettings and Management perspective, process-wise?
Yeah, so obviously, again, for ourselves, we actually see this site almost on a daily basis. We have an office, as George made reference to, in Birmingham. For the units that are coming forward for completion, for ourselves here at Brick Management Lettings, we will effectively sort of handhold all of our landlords and fully sort of oversee the onboarding of the unit onto the rental market. So upon successful legal completion, we will attend the property and collect the keys on behalf of the landlords. With that, we would actually go along and snag the apartments as well, because again, many landlords are overseas, George. So, with that, we will be their eyes and ears. So we will go around and do a comprehensive snagging report that we would share with landlords as well as the developer, of course. With that, I mean, we would look at cosmetics. We'd make sure that the kitchens are correctly fitted. There's the spec and finishes as per planned. And again, we would oversee that the works get completed and again reported back to the landlords, just for again peace of mind for them, to ensure they get an A1 product. Obviously, during the time once completing is happening, once the snagging is being completed, at that point we actually bring the properties to the marketplace, so we bring them onto the rental. As it stands at the moment, you made reference that obviously it's a phase 3 of a bigger scheme. We've been involved with the earlier phases almost back 15 months now. So again, we have a lot of tenants that are always looking for that particular area within the jewellery quarter, or we have a bit of a waiting list of applicants. And again, obviously you would imagine we've got a bit of a pipeline of actually tenants waiting for some of these new apartments to come to market.
Okay, and just a few questions, and a few questions come in, and a few other questions prior to the event. Non-resident landlord. So anyone joining this call, meeting, webinar, if they haven't applied to be a non-resident landlord, that is a process that needs to be done imminently, isn't it?
Correct. Yeah. I mean, we advise all our landlords, prospective landlords, coming on to apply before you collect the keys. Before that stage. I've dealt with a number, obviously, of clients there, but we will provide them with the links and the reference numbers, so you can get ahead and process that with HMRC directly. It doesn't cost anything. All it takes is a bit of time, and it's, again, in terms of timescale, it's sort of 4 or 6 weeks, something like that. It appears to be currently for the application. So now's the perfect time to do that.
And an NRL, a non-resident landlord application, is required, just for the benefit of the
yeah. So
it is required in order to register with UK Inland Revenue, HMRC, from a tax perspective, so that you, as a letting and management agent, do not need to withhold 20% of the rent. Yeah.
Correct. So any landlord that is based overseas that has purchased the property in their personal name. So if it's a personal name based overseas, in order to, as George correctly said, for us not to withhold 20% of rental income for taxation, you just need to apply and register for your NRL, your non-resident landlord status. Upon receipt of that confirmation from HMRC, we would release the rental to you gross with no deduction, the same as we would do for any typical UK-based landlord.
Yeah. So the onus is on you, isn't it? So withholding tax, essentially, onus is on you as the agent managing the property to withhold that until you have the non-resident landlord number. So any clients maybe need some more information on that, please do get in touch with Phil. Next question, Phil, if we may, just, I know we're going on now. 1 beds, 2 beds, what sort of rentals should we expect on Scholars Quarter? They vary in size, obviously, slightly, but on average.
I mean, generally speaking, obviously for the the demand for the market in Birmingham is 1 and 2 beds, so that's the main stay of all tenants looking. In terms of rentals, 1 beds, 950 to sort of 1100 per calendar month. 2 bedrooms, 1250, 1400, 1450, depending obviously on sizes. But they're the sort of rentals that are being currently achieved at the moment on apartments within the jewellery quarter and within Birmingham itself.
Okay. Void periods, roughly, what would you manage clients' expectations, void period?
Yeah, I mean, generally speaking, to bring a property, as I highlighted earlier, from coming on to collecting the keys to effectively finding a tenant, we're within under 2 weeks, 13.2 days, I think is the average. I mean, again, within that sort of sub 2 weeks is realistically what we would suggest.
Okay, excellent. So I'm just firing stuff at you. Service charge collection. So we know it can sometimes create issues. Freeholders serving service charge notices on the tenants, which doesn't get to the landlord. There is the ability, obviously, for you to manage that process on behalf of clients with their authorization.
Yeah.
Could you maybe just talk about that?
Yeah, certainly. And so again, obviously, by obviously being being a leaseholder within these blocks, there'll be a block management charge, a service charge for the communal cleaning, upkeep of communal gardens, lifts, for example. Again, that tends to gets billed either a quarterly or every 6 months. But for our overseas landlords or landlords in general, we tend to offer that facility to all landlords, and they uptake it, that we actually pay that and monitor that from the rental income received. Generally speaking, for an overseas landlord, you might not necessarily get the email, overlook it, you might get the post. Being here based in the UK, we would encourage you to have all the mail come via ourselves, and that we might keep on top of that for you, and again administer that for you. And that's something that we do as part of our service. We do not charge any extra for that.
Yeah, highly recommend customers do that. As I also highly recommend taking rental protection insurance. Obviously, Phil, from your perspective, there's a process you need to follow, vetting prospective tenants, credit checks, referencing, and so on and so forth. Make sure they're upstanding before they are able to take on a tenancy agreement. Obviously, landlords need to approve anything anyway. Can you just tell us a little bit about rental protection insurance and what that offers to our clients?
Yeah, I mean, again, obviously for the rent protection, it's something that we strongly recommend for landlords to obviously consider uptaking. The vast majority do so. It's 100% peace of mind, really. It's there in the eventuality there was ever an issue with the rental. So, I don't know, job loss, marital split, ill health. The tenant was to feature some sort of financial difficulty, didn't pay the rent. This product basically kicks in and covers your rental income. It carries on until such point where, again, it provides the cost for the legal process in order to get the properties back. So again, just for your own peace of mind, it all gets continues on as planned. I suppose that the easiest way to really explain it is as such, you wouldn't drive a car of £12,000-15,000 and not have insurance on it. Very similar sort of mindset really should be seen.
Yeah, I mean, I highly recommend do it myself, because it makes investments more watertight, doesn't it, really?
Yeah, and also more importantly, with the tenancy in situ, there's no guesswork of hopefully you'll get X amount each year. You will get X amount.
Yeah, exactly. So peace of mind.
Exactly.
Fantastic. Just mindful of time, so just a few more slides to share, and then we will conclude. For anyone who's got any further questions, anything that's been missed, apologies, just mindful of time. Bill and his team are available to assist. If you haven't appointed BRIC as your management and lettings agent, then again, please do get in touch with Phil and his team, or your RPA advisor. And any other questions you might have, they'd be happy to answer them. Just going to give a quick snapshot. We always get asked by clients, what's happening out there in the market. It's a positive outlook, and we've got a whole load of really exciting new developments that we have just launched. Sloane Court mentioned there, One Victoria, fantastic new Manchester development, Gleddles Wharf, beautiful new Riverside development up near in Lincolnshire. A Berlin development. We're so excited about launching another Berlin project. Fantastic market and many benefits for clients investing in Germany. Primarily, I suppose, if you've got UK property as a diversification tool, euro exposure, tax benefits, and so on and so forth. We've got some amazing London product, landmark Canary Wharf development, Northwest London development there with Barratt Homes. Then finally, a very exciting ongoing development with King's Crescent Homes in Brighton, which presents a fantastic short-term lets opportunity for anyone who's looking to drive up that sort of the rental return. Most people joining are customers, but in terms of our services, we're a full end-to-end service provider from start to finish in the property transaction. And just in closing, just wanted to show this slide really. So this looks over the last 70 years and compares the UK property market to, various indices. So the UK on average every year, 7.3% return against the Dow Jones, the Nikkei 225, cash, gold, and the FTSE 100. So yeah, pretty decent, I think it's fair to say. And if you look at capital values in the UK, on average, typically every 10, 15 years post Second World War, they've doubled in value. So there's still fantastic opportunity to buy in the UK. It's a very safe and steady arena to invest. It's a proven product. Right now, it is still a buyer's market, I would say. There's a lot of confidence returning to the market with taking into consideration all the factors we've spoken about in this webinar. But it does create an opportunity for buyers now before too much confidence comes into that market and prices start increasing quite significantly, which we're already starting to see, I think. The lending costs have fallen considerably. If you're buying off plan, the cost of your financing will be significantly less in 12, 18, 24 months from now than it would be if you completed today. And as I touched upon, the supply and demand fundamentals are still there, or the supply shortfall, I should say, is not going anywhere in the short term, which creates a safe and secure market to invest in and will continue to drive up capital values and rental values. Philip, thank you very much for your time. Ladies and gentlemen who've joined today's webinar from around the world, thank you very much for your time. We really appreciate you taking the time out to join. I hope it's been useful. We will circulate a recording. Please feel free to pass it on. And for any other questions you might have, you can scan that or be more traditional and just contact us on telephone or by email, because you should have our information. So thank you very much, Phil. And,
Thank you.
You take care, and we'll be in touch. And I hope everyone has a lovely day. Take care.